Hey there, financial enthusiasts. Welcome back to our channel. Today we're diving deep into the world of investing and discussing a hot topic that's been making headlines: the impact of higher interest rates and inflation on young investors. According to a recent Bankrate survey, almost 9 in 10 young investors have been actively trading stocks this year in response to these economic changes. But is this strategy helping them or hurting them in the long run? Let's find out. In recent times, the Federal Reserve has been aggressively raising interest rates since March 2022 to combat persistently high inflation. As a result, borrowing costs have reached their highest levels in over 22 years. However, it's essential to note that inflation has also decreased significantly since reaching a peak in June 2022. Last year, U.S. stocks faced their worst performance since 2008, given this challenging economic backdrop. But the silver lining here is that higher interest rates have meant better returns on savings accounts, especially those offered by online banks. Despite the economic turbulence, the S&P 500 stock index has shown resilience, bouncing back in 2023 and boasting a 14% year-to-date increase. Now here's the fascinating part. According to Bankrate, a whopping 87% of Generation Z investors have actively responded to these higher interest rates and inflation by either buying or selling stocks or even holding off on further investments. This figure is significantly higher than the 52% average among American investors of all ages. To gain deeper insights into this trend, we interviewed James Royal, a Bankrate analyst responsible for this research. According to James Royal, younger investors who frequently trade in and out of the market are almost certain to underperform. But why is this happening? One explanation could be that Generation Z, and to some extent millennials, have never experienced a period of high interest rates or high inflation. However, certified financial planner Ted Jenkins warns against allowing emotions rather than logic to guide investment decisions. Emotion-driven decisions often lead to poor financial choices. According to Ted Jenkins, making investment decisions based on emotions is generally a bad financial decision. One common pitfall of active trading is that investors often miss out on the market's biggest days, which can have a significant impact on returns. Additionally, it can lead to higher taxes for investors. A historical analysis by Bank of America reveals that investors who missed the market's 10 best days per decade would have had a total return of just 28%. In stark contrast, those who held steady would have enjoyed a whopping return of 17,715%. So, what's the best strategy for young investors in this environment? Interestingly, young investors were more inclined to buy stocks rather than sell compared to other age groups, as per Bankrate's findings. This could be beneficial if they commit to holding their investments for at least 5 years. Ted Jenkins advises using the rule of 120 for age, appropriate stock allocation. Subtracting your age from 120 usually results in a portfolio over 90% in stocks. Furthermore, it's generally advised that investors consider buying mutual or exchange-traded funds that track market indexes, like the S&P 500, a strategy known as passive investing. This approach often proves more effective than trying to beat the market through active trading. What do these insights teach us? The crucial lesson is that while responding to economic shifts is normal, rushing into investment decisions driven by emotions or trying to time the market can harm your financial future. This discussion aims to illuminate how young investors can adeptly handle the challenges posed by higher interest rates and inflation. Keep in mind, a carefully planned, long-term strategy often outperforms impulsive short-term actions. Thanks for tuning into our channel. And remember, informed decisions are the foundation of financial success. Until next time, stay financially savvy.